The Queensland government is robbing property investors blind. They are doing it shamefully. They've introduced this new tax. I'll be going through what the tax is and what the consequences of that tax will be. I'm not happy, I can tell you that right now. And if you are a property investor and have property in Queensland or are looking to buy in Queensland, you're going to want to stick around right till the end. It's going to be raw, because it will affect you. Welcome to the Oz Property Investment Mastery Podcast. My name's PK and I help busy people build passive income by buying top 5% growth and positive cash flow property and build a portfolio using data without wasting months doing research, spending weekends at inspection or catching flights, or dropping $10,000 to $20,000 on buyer's agents every single time. So if you're confused, lack confidence, and just overwhelmed with all the information and marketing misinformation available online and don't know where to start, then this show is for you. Okay, so what has happened? Effectively, Queensland government has come out and said, the Treasury to be specific, that, before there was land tax, it was calculated upon a certain threshold of property ownership in Queensland itself. So let's say you had properties, where the land component was worth up to $500,000. You don't need to pay land tax in Queensland because the threshold is $600,000. Okay, you only pay tax on property where it beats the threshold, is above $600,000. Now they've completely rehashed that, and they're saying that even if you only hold $300K of property, land that is, in Queensland, but you have $1 million of property in Melbourne or Sydney or anywhere across Australia, any state and territory, they will include all of that in the threshold calculation. So let's say you have one investment property in, I'm just making this up, in Sydney for $1 million, just keep a round number. You automatically beat the threshold, that $600,000 threshold for individuals in Queensland. And so therefore, the portion of land that your Queensland property is valued at, that is going to be land taxed. Let's say that's $300,000. That's still going to be land tax because they're saying you actually own $1.3 million of taxable or threshold accessible property. And when I say that property is worth, I'm just meaning land tax. And by the way, none of this is financial advice. These are my rumblings and grumblings. I might misspeak and get something wrong. So speak to your accountant. But they're effectively double. I can tell you my own situation. Like, as an example, I have a property in Tasmania. In fact, I have two. All right. And in Tasmania, they tax you. There's land tax basically from the get-go. There's not really any threshold, any meaningful threshold there whatsoever. So I'm paying land tax in Tasmania. This is a personal situation, right? And let's say I wasn't paying land tax in Queensland. Now I will be paying land tax because I hold property outside of Queensland as well. Okay, so they have now jurisdiction to assess your threshold nationally. All right, and that's really bad. Like, that pisses me off, right? That really does piss me off. Keep in mind that in Australia, in most states, each trust or company gets its own accessible threshold. So for example, in Queensland, a trust gets $350,000 of land component before you start paying land tax. All right, so I'm going to get to the consequences and what we can do about it, but each trust or company still gets its separate quota. So maybe going forward, maybe, I'm not saying this is not personal advice, maybe it's better to buy in an entity going forward if you're looking to buy Queensland properties, if you already hold significant property in other states and territories, because each company, or I should say trust actually, each trust gets its own threshold. Okay, that's always been the case. Even if, there was previously two ways you could avoid paying land tax. You would buy in different states because each state has its own threshold, or you would buy in different trusts or companies, because every trust has its own threshold, even within the same state. Okay, so for those of you who live in Queensland, and this tax isn't limited to Queensland residents, it's anyone, right? It's anyone who holds property in Queensland or will hold property in Queensland, right? If you're a Queensland resident, you can still try to avoid this by buying super cheap properties and buying them in a different trust every time. But keep in mind the ownership structure or the ownership costs of trust setup and maintenance can be cost prohibitive. The only state, to my knowledge, the only state where you can't avoid land tax by buying in different entities, like trusts, for example, is South Australia. To my knowledge, if you buy in your own name in South Australia and you also have property in a trust, the South Australian, state government views it all as one. There's a way in which they can figure that out. So back to what has happened. What has happened is they have effectively said, I will no longer, the government will no longer just look at your Queensland property holdings to calculate your land tax, but now we'll look at your national property holdings. And it's not grandfathered. This is a stupid thing as well. It's not grandfathered. So it's not like you've made investment decisions in the past that they will honor the parameters, the ground, the playing field on which you made or from which you made those investment decisions. No, they're just saying, from now on, and in fact, 30th of June 2023, these are the rules, regardless if you buy property now or you bought property 10 years ago. That's just ridiculous. So what does this mean? This is obviously the consequential part of it. What does this actually mean? What will be the impact on property investors? What will be the impact on the rental market? What will be the impact on Queensland's property market in general? So the first thing I want to mention, and this is for everyone who might be high-fiving themselves thinking, property investors are a bane of our existence. Property investors are the reason why properties are so expensive in Australia. They're all the devil, etc. A bit of hyperbole there. The fact is that in Australia, there is a chronic shortage of housing. So if you think that property investors are the reason why Australia has so much economic and social difficulty when it comes to housing, that is just not correct. That is just not correct. In fact, we need property investors because the government ain't building or doesn't build enough housing. And there's a chronic lack of housing, especially in Queensland, regional Queensland, even in Brisbane. Places like south side of Brisbane, Cleveland, and those kind of areas, rents have gone up like $150, $200, from $400 to $500 to $700, $800 within the space of 12 months. That is how much there is a chronic lack of shortage of housing. And therefore, if you don't have sufficient, ample property investors, rents just go up and up and up because demand is there. With immigration as well, demand just continues to rise, supply doesn't. So what happens? Rents rise and everyone blames it property investors, even though they're the ones providing the solution. Of course, I'll say that, right? This is a property investing channel, I get it. But these are just facts. And I've done a whole analytical piece, a video, I think a week ago. I'll link that to the end. But that's my first prediction. Rents are already going up in, places like Toowoomba, Townsville, Rockhampton, Bundaberg, Mackay, Sunny Coast, Brisbane, Cairns, everywhere rents are shooting up. It's a huge problem, right? Socially, it is a problem. Let's not beat around the bush. It's not a good thing socially, but this problem is going to get even worse. It's going to be exacerbated because this additional tax places another cost of holding property, and therefore there will be a subsection of property investors, and I'll get to who those may be and whether it will have a material impact. There might be a subsector of property investors, whether they're Brisbane locals or Queensland locals or interstate, that think, hey, you know what, this has just pissed me off. I'm not investing in Queensland. To hell with it. It's too hard. Another $1,000, $2,000 of potentially land tax that I'm going to pay if I have $1 million of property in Sydney or Melbourne or somewhere else. Forget Queensland. Those are the types of property investors Queensland needed the most to provide a rental opportunity for a potential tenant. Now that tenant doesn't have that property to be able to rent, therefore they've shrunk the supply pool of rental properties, rents will go up. So that's one consequence. And obviously, Adam Smith, the invisible hand economic theory is that when rents go high enough, that will then overcompensate for that cost prohibition, that will overcompensate for that additional cost that land tax will bring in, additional land tax will bring in. And so therefore, it will be like, well, land tax has gone up, but rent's gone up even more, disproportionately more. So it now once again makes sense to invest in Queensland. So, this is how economics works, how property market works. But there will be a subset of people that will just be pissed off more than anything, a bit like I am. The second thing that I just want to mention as a sort of nuance to that story is that, whilst we are pissed off, whilst we aren't glad that this has happened, I've been investing in property for long enough, and even if I've not been around to experience major policy shifts and changes, like when I think for 2 years or 3 years or small period of time, they abolish negative gearing only to bring it back. When you look at these policies that we think the property investing thesis or the housing market rests upon, when they actually change that and you look at what it's actually done to the property market, you find that the data isn't hugely consequential. For example, when they got rid of negative gearing, it's not like property all of a sudden fell by 20%, right? Or even 10% or even 5% in most places. That's what kind of just on the surface skimming, that's what you'd expect to happen, but it doesn't quite happen that way. And that's the most extreme example, right? And these types of additional land tax here, or I remember a few years ago, they reduced the ability to depreciate your house. You could only depreciate things like capital works, not renovations done by someone else. That effectively is the same amount of quantum delta, or that is the same amount of difference it will make to a property investor. Before, you could depreciate, you claim another $2,000, $3,000, $4,000 in depreciation tax benefit. Now you can't. That was, I think, 2017 or something. This land tax thing, for most property investors, let's be honest, those who aren't successful get stuck at 1 or 2 properties. For them, it's not a big deal. And that is more than 90% of property investors, right? So if you have 1 or 2 properties scattered around Australia, one of them happens to be in Queensland, like this additional land tax, maybe $500 a year, maybe $1,000 a year, isn't a huge deal, right? It's even less of a deal when they got rid of that depreciation added benefit, right? And even before that, or I think around that time, Royal Commission time, they reduced the ability to claim a deduction on travel expenses when flying interstate or even going within a state to visit your property. People were claiming $1,000 a year, $2,000 a year, $3,000 going with their family to the Gold Coast. They had investment property there, but they were claiming it as a property management, inspection or something, and getting a tax refund. All those things, whilst in that time they seem very preposterous, which in some respects they are, and that they will crumble the property market, they don't actually have a material effect. So and this is the same. This is no different to one of these dozens of policies I've seen before that haven't really been consequential. There's not enough of a critical mass of people that care enough, that are impacted enough. When you look at statistics, 2 million property investors, there's not enough that are actually impacted for us to be able to say, for me to be able to say that, hey, there's going to be an exodus, a flight away from Queensland, and Queensland property is going to come down. Statistically, it just doesn't work like that. Like maybe a lot of sophisticated investors watch my content, listen to my content. I'm very grateful for you. For you, it'll have more of an impact, but for the average investor, not so much. Like that's the truth. And the other thing that I want to mention as well is that land tax is actually deductible. Okay, now I'm not an accountant, verify anything that you hear in this video, but land tax is deductible, right? Land tax is deductible. It's a tax, but it's one of the few taxes that are actually deductible. So yes, you're going to pay another $500, $1,000, or for those of you more sophisticated, have more investment properties, $2,000, $3,000, whatever it is, make up the number. I'll leave a link below actually to the Queensland website that explains exactly what has happened, what is going to change. They've given in some examples as well. Mary has this here and this is how it will impact her. I'll leave a link below in the description. But where I'm going with this is that even if you're paying another $3,000, $2,000, $1,000 on land tax, because of this new double taxation rule, it's deductible. So if you're on the highest income bracket, 45% or whatever it is, you're getting a chunk of it back. Now that, we don't like to invest in property with the perspective of saving tax, but it's still there, right? It's a truth that we can't avoid. Now, the other consequence that I want to go through about Queensland making this, audacious change in their land tax rules is that probably, I can't predict the future, but probably other states and territories are going to follow, right? Like it's a cash grab, easy way for them to make money. There's a precedent set. It's going to be, or might need to be, treated as another cost of investing, additional costs, just like property management fees, council fees, etc., etc. It's another thing that you should be factoring into your budgeting. All right, and that just goes to show how much more important it is now than ever to buy high-yielding properties. So for all these property experts that say, guys, forget about yield, just buy in Melbourne, Sydney, buy something 3% yielding, 3.5% yielding, because those cities go to the moon and back in terms of capital growth. We don't want to invest in property that is loss-making with the hope that it will rise in value. Of course, using data, you can predict that fairly accurately, but we don't want to be making $10,000, $20,000 loss in our property business every year only to want or wait for that capital growth. That's why it's so important now more than ever to buy those high-yielding properties above 5%, above 6%, above 7%, and as for those of you who are clients watching, you can still snag some, not so many, some 8% plus yielding properties, especially in Queensland, right? So yes, land tax, sucks. This additional land tax, it absolutely sucks. But if you're able to get these super high yields in Queensland without sacrificing the capital growth, these types of yields aren't on offer in most parts of Australia, unless you go to a mining town, which you really shouldn't do that. So it kind of compensates, right? Like you're investing in Queensland, super high yield, yes, a little bit of additional tax, but the yield story still checks out. The other consequence, all right, the last thing that I want to say is that this should not put you off investing in property. Okay, do your own finances. If that additional $500,000, $1,500, $2,000 is a deal breaker for you, then don't invest in that property in Queensland. Simple, right? It's just maths. But long term, to build a 75, 100, 125, 150K passive income in 15 years, 20 years, 25 years, by the time you retire, whatever that story is for you, this additional cost is not going to mean you can't achieve that. Okay, in the scheme of things, in the context of things, it is so tiny. Just like yesterday on Sunday, I took my son and my wife, we went to the planetarium in Brisbane and Mount Gupta, and they kind of have this dome, and they showed how Earth looks from Saturn. Apparently they sent a satellite or some sort of thing to Saturn. Was it Saturn or Jupiter? I can't remember. But then they kind of took this photo back at Earth, right? And Earth was so tiny and inconsequential and just kind of meaningless in the scheme of the Milky Way, in the scheme of the galaxy, right? That is almost what this change is. This should not mean we stop investing in property. It's just another thing to factor in. When you're 30 years from now, looking back, you're going to regret not investing in property as opposed to regret buying property but having to pay that additional $1,000, $2,000, $3,000 a year, because the outcomes are going to be largely the same. Capital growth is the engine, cash flow is the oil. Okay, if you have those both ingredients, you're going to make a nice cake. You're going to get that outcome. I mixed two analogies in one there. So, what's the conclusion? This is a terrible policy. It's another cash grab. The government are absolute robbers. I'm not happy with them, but what I think doesn't matter. At the end of the day, it will and could put some investors off, especially if the additional $1,000 is a deal breaker. In the long term, it should not put you off investing in property. And The other thing I will say is that rents will go up. And the way that economics works, everything ultimately reaches equilibrium. Rents will go up at such a speed or velocity or trajectory in Queensland, especially, where those additional rents will absorb or soak up or suck up the additional cost of this land tax. And in the long term, the market will go back to equilibrium. Welcome to capitalism. Capitalism means a social divide, inequality. That's the reality. You know, I'm just the messenger. I'm not the maker of the game. Choose which side of that equation you want to be on. Level up your education, because knowledge is power. You should be investing in your mind, in your knowledge, in your intelligence before investing in any real estate. But hopefully this was valuable. I'll see you on the other side, guys. See you later.